Hello, I'm Wendy Edelberg, Director of the Hamilton Project. I am delighted to be welcoming you to our first day of a two-day event, Recession Remedies, Lesson Learned from the U.S. Economic Policy Response to COVID-19. The COVID-19 pandemic took a devastating human toll. More than 6 million deaths worldwide and nearly 1 million of them in the United States. It also posed an extraordinary threat to the U.S. economy. It was one met by a swift, forceful, creative, and largely successful response from fiscal and monetary policy. When the next recession arrives, it will most likely not be caused by a pandemic. And policymakers will ask, what did we learn from the economic policy response to COVID-19? What should we do again, perhaps with improvements? And what policies should we avoid? The Hamilton Project and my co-editors, David Wessel and Louise Shiner from the Hutchins Center, put those questions to more than 24 scholars for a book we published today, Recession Remedies. It examines all that Congress, the White House, and the Federal Reserve did over the last 2 years. Although it is too early to give definitive answers to every question, the next recession will surely arrive before we have all of those answers. And we do know enough now to draw a few overarching lessons. Today's event will highlight the authors of the 9 different chapters. We will cover the breadth of the response, unemployment insurance, the economic impact payments, also known as rebate checks, support for businesses, housing policy, support for both renters and mortgage holders, support for the state and local sector, policies aimed at the well-being of children, the interactions of monetary and fiscal policy, and finally, what lessons we learned from the use of non-traditional data. Tomorrow, we will be in person at the Council of Foreign Relations in Washington, D.C., and streaming online. At tomorrow's event, we will hear from our keynote speaker, Secretary Janet Yellen, and we will hear from policymakers and those who helped administer the fiscal support. We will have 2 roundtable discussions tomorrow focusing on how well the federal economic policy responses were designed and what we should keep in mind when the next recession hits. Thank you to everyone who has submitted their questions in advance, and we will continue to accept your questions throughout today's webcast at info@hamiltonproject.org and also through the Hamilton Project's Twitter account at HamiltonProj. Additionally, we will be live tweeting the event using the hashtag Recession Remedies. Okay, so Jason, you, Tim Geithner, and I wrote the first chapter, Lessons Learned from the Breadth of Economic Policies During the Pandemic. So let's start our conversation with you highlighting some of the lessons that you took from our work. What lessons from our chapter do you want to highlight?
Great. Thanks so much. And by the way, all the chapters in this volume are terrific. I learned so much from all of them. And it will just be a real resource for a long time to come. With you, Wendy, we were partly trying to draw on the chapters, but partly trying to look at the broader macro picture, both in the United States, and maybe we'll come back and be able to talk a little bit about compared to other countries as well. One of the amazing things is if you looked at the GDP or unemployment data, you would see the fastest, sharpest recession that the United States has ever experienced, and almost as deep a recession as we've ever experienced. The unemployment rate, of course, got higher in the Great Depression. But if you looked at the numbers on disposable personal income, or on poverty, or on income by quintile, or by racial group, or ethnic group, you wouldn't see the recession. In fact, you'd see the exact opposite of a recession. You'd see an enormous boom with incomes going up. And so the first lesson is just creating a wedge between what is happening in terms of GDP, which couldn't, in this case, you didn't want to protect. In a normal recession, you might want to protect it, but maybe you can't fully protect it. Between what's happening with GDP and what's happening with people's incomes, especially middle and lower income households, is possible. You can use transfer policies, you can use unemployment insurance, you can use benefits like SNAP. There's just a lot of things you can do to protect families from the worst consequences. A second related lesson is the recovery here was incredibly fast compared to the last recession, compared to most other recessions we've experienced. That will debate forever the ratio of importance of two factors to that speed. One is it was a different type of recession, a natural disaster in part that went away. But that natural disaster, or not went away, that we learned to live with, that natural disaster, though, lasted for, a year. It lasted for 2 years. In some ways, it's still going on. And so the policy response was also essential. We never could have had people go out and spend money in 2021 if they hadn't had any money left over from 2020. So policy can make a difference, and a big difference at the macro level as well. So Wendy, I've, sometimes, I talked about some of the good things policy did. Are there any sort of more negative lessons that you could draw?
So given the surge in inflation and consumer demand we are experiencing, some of the questions around the size of this fiscal support have had the tenor, well, would you have preferred we had done much too little? And my answer to that question is no, but it's a false choice. So I think the more useful question for future policy is, should we have done a lot, but less? And there, I think we learned the answer is yes. Over the course of the crisis, particularly in 2021, the increase in fiscal support was too large. And it is worth exploring to what degree this was knowable at the time and to what degree this is only clear in retrospect. Doing too much can have serious downsides that might be difficult to mitigate, as we are currently experiencing. As the economy gets close to its capacity to produce goods and services, additional macroeconomic support that boosts demand will feed increasingly into inflation instead of improvements in output and employment. Now, it was clear a year ago that the fiscal support in 2021 was going to push the economy in unsustainable ways. At the time, I thought that created risks from inflationary pressure and the risk of even more importantly, the risk of a hard landing when the economy slowed. But I also thought at the time that the extent of support offered a lot of insurance that the recovery, at least for a time, would be robust. Now, with hindsight, I underestimated or just failed to anticipate various factors that held back real activity and created inflationary pressures. But still, it's worth asking, was the risk-reward calculation the right one? And I think we can say we can do better next time. From a macroeconomic perspective, the timing and extent of monetary and fiscal support should be better matched to the economy's ability to provide goods and services financed by that support. But as we talk about later in the chapter, and I know you and I are going to get to, Jason, there are ways of building in the size and the timing of policy that would be great improvements over the surge in fiscal support that was concentrated in the middle of 2021. So, Jason, I know you've thought about these issues too. What do you want to add?
I agree with everything you said, Wendy. I think I might have made the argument that it was knowable in March of last year, that this was larger than any conceivable size, either in terms of need of people or in terms of something like the output gap, that there are downsides to doing too much. And we are living with those now as real wages are falling at the fastest pace in 40 years. And regardless, I wouldn't just think about fiscal. I mean, fiscal, in some ways, it was complicated. You were making a decision, first of all, with a lot of political incentives, not just economic analysis. That's always true of fiscal policy. That is not a criticism. I've done that a lot myself. You were making a decision in January when things were more uncertain, 3,000 people dying a day in the Delta wave. You weren't quite sure what the vaccines were going to be like. And then it took 2 months for it to pass. It's harder to change. In some ways, the Fed's error was probably even bigger in that they continued to make the error for month after month as the economy improved, as it was clear that vaccines, at least at first, were working a lot better. They also have less politics in the Fed and a larger number of economists. So I think in some ways, the erring on the side of too large there may have sped the recovery a bit, but at the expense, potentially, of some problem in the future. And in some ways, that's TBD. I want to get to our next lesson, Wendy, which is the worst type of lesson to have. If you write an academic paper, your conclusion is more research is needed. A lot of people put a lot of thought into this volume. You hate to have any of your lessons be more research needed. But on the one place where I feel we still don't 100% know, but the question is so important, policymakers need to be asking it, researchers need to, is what can we do in a future recession to protect more jobs or speed the recovery of jobs and have a better job recovery? Now, we've had quite a good one. 3.6% unemployment is unbelievable after what we went through 2 years ago, but still labor force participation hasn't recovered. And if you compare the United States to pretty much all the advanced economies, we lost more jobs up front, and our recovery left us behind them in terms of employment at almost every stage of the last 2 years. Now, what's interesting is that also happened in the last crisis, in the financial crisis. And what's also interesting is it happened despite the fact that in both the financial crisis and this one, our GDP recovered faster than any other place. And so to me, a first order question is, what can we do in the next recession to prevent conditional on amount of GDP, maximize the number of jobs? Maybe that's more aggressive prorated unemployment insurance, also called short-time compensation, or job sharing. We have that in a lot of US states. The take-up was incredibly low. Maybe we need to redress the balance of how you think about fraud prevention versus take-up. But to me, that's a really, really big question, is can we do even better on employment next time than we did, not just this time, but the last time as well. And Wendy, do you want to close it out with our final lessons from the chapter?
So let me say two things. So first, a lesson that both you and I knew before the pandemic, but was laid bare yet again, is that fortified automatic stabilizers would help both reduce errors of doing too little and, as I highlighted at the beginning, and Jason talked about more, errors of doing too much. So policies were put in place that had abrupt and arbitrary cutoffs in the fall of 2020, for example, leaving people in dire straits and leading people like me to be jumping up and down on the sidelines saying we need to do more. The Hamilton Project has written extensively about how to make automatic stabilizers more effective. And I encourage everyone to go look there. There is no shortage of ideas. And the last thing I'll say is, one thing I was struck both in putting together our chapter, but also in editing the whole volume, is how it's basically impossible to understand the effect of any policy in isolation. So like in understanding the effectiveness of policies put in place to help renters, one might think, renters who we worry are going to be behind on their rent. One might think that we should look to eviction moratoriums or the emergency rental assistance to see how effective those were. But in fact, equally, or maybe even more important, was the income support for households through unemployment insurance, the economic impact payments, through the expansion of the EITC. So policies, what we learned is that policies that do more to mitigate the loss of income in the midst of a recession and help households who go into a recession financially vulnerable, the more we do those policies, the less we need to do other policies. So generally speaking, here too, we have more to learn on these fronts. Policies need to be better targeted in future crises. And that's going to require improving systems and policies in advance, so we don't have to stand up new programs all at once. And so we understand who needs help, who's not being reached by fiscal support, and making sure that we have the infrastructure to help those people efficiently. So we have a long to-do list for policymakers and a long to-do list for future academics in doing this research. But it's, there are lessons that I hope will be useful for future policymakers here. And thank you very much for the conversation, Jason. And thank you for writing the chapter with me and with Tim. I learned a lot, and I hope people enjoy the chapter and get a lot out of it. And now we are going to pivot to a conversation that I am going to have with two of our authors, one who wrote with co-authors the unemployment insurance chapter, Fiona Gregg, who and there she is, excellent, and Mel Steffens, who co-authored our chapter on the effectiveness of the economic impact payments. I am pinch hitting as moderator here, but I'm super excited to be having this conversation with them. In some ways, these chapters are after chapter 1, these chapters are chapters 2 and 3, because in some ways, these two policies and the enormous innovations around the unemployment insurance system and the economic impact payments did probably the heaviest lifting with regards to getting fiscal support to households. You really can't understand, just as I said at the end of my conversation with Jason, you really can't understand the effectiveness of any other policies without understanding how unemployment insurance mattered for a particular household and how the economic impact payments mattered. So it is completely natural that we are now starting with both you, Mel, and Fiona. And let's start with you, Fiona. Why don't we start with what were your empirical findings that as you combed through how the unemployment insurance expansion mattered for the unemployed?
Thank you, Wendy. It's really great to be here and represent the work of myself and my co-authors. The unemployment insurance expansion during COVID was historic. It was really enormous. And we expanded, UI in 3 ways. We increased the level of benefits. We extended the duration of benefits, which we normally do, but we also expanded the eligibility of benefits. And these were really material expansions. So in June of 2020, UI represented about 9% of all compensation. And never before had it been anywhere close. It was 4-fold larger than ever before. So these were really material expansions. So what did we learn? So number one, these expansions were actually very progressive in terms of how they offset income losses that were experienced by families. That's for 2 reasons. One, the job losses were disproportionately experienced by lower income workers. But also secondly, those flat supplements of $600 and then $300 were of course disproportionately larger benefit increases for low wage workers than high wage workers. I'd say the second empirical lesson was that the spending impacts of these UI payments were really large and provided a really meaningful stimulus to the economy at a time when, the spending of everybody else had been cut, right? At the beginning of the pandemic, we all, were shut in our homes. We stopped going to restaurants. We stopped getting on airplanes. We stopped doing many, many things. And yet what we saw in terms of spending trends among the unemployed is that their spending actually increased relative to their own baseline, in large part because the typical unemployed worker was receiving more in unemployment benefits than they had received, than they had been earning. So we saw a pretty big marginal propensity to consume, 0.3, 0.4. So that was, the spending impacts were large. The third empirical lesson is if we think about the cost benefit of this kind of relief, right? The benefit is the spending impacts, they were big. Well, what about the costs? The costs we worry about are the work disincentive effects that this might be bearing down in terms of how the labor market might come back. And when we measured those, we could detect a work disincentive effect, but they were small. Small against, 3 different yardsticks. So they were small relative to historical literature. And, in 18 other studies we could drum up, they were much smaller. Small in terms of the aggregate impact this would have delivered if we didn't have these supplements compared to the big aggregate pool of missing workers that we had at the time. And then, of course, small in comparison to the spending impacts that I mentioned. So that was the third really important and perhaps biggest surprise out of this UI experiment, of that the work disincentive effects weren't as big as perhaps many might have thought. And then finally, another important lesson was specifically about the PUA program, which was a huge expansion, represented about 40% of claims when it was up and running. And this was really quite successful in increasing access to benefits and ensuring income losses for people who normally didn't have access, weren't eligible, right? These were self-employed, gig workers, people who are experiencing COVID themselves or caring for others who were. These tended to be individuals who are at the margins of the labor market. They were lower income, either our most youngest workers or eldest workers. And yet we didn't necessarily see that there was greater work disincentive effects among this program either than traditional UI. So all told, we thought this program was a success. Now, there are some administrative shortcomings that I think we are really important to acknowledge, that were costly in terms of not just consumer welfare, but also government expense. So these are things like delays in UI payments, especially at the beginning of the pandemic, which were, especially important in the PUA program, which we had to stand up afresh. Red tape, right? People kept getting kicked off of UI at different moments after their first 52 weeks. Disparities in UI recipiency were still a challenge, and of course, an increase in overpayments. And I think, in terms of this, the risk of overpayments and fraud as being another perhaps cost or concern around UI. I think it's important to think about this in a sort of glass half full frame, actually, because overpayment rates are typically around 10%. During COVID, the best estimates we have is that they increased to about 18%. But that was at a time when we effectively got rid of so much of our, third-party verification and our controls that are intended to prevent that fraud. So another way of putting it, with very relaxed controls, 82% of the time, UI payments went to the right people. So, those are just, I'm going to stop. Those are some of the empirical points I wanted to make, Wendy, because it was such a big experiment and so much to learn.
That's super. And we will definitely come back to you because I have lots more questions. But for now, Mel, the same question to you. What were the empirical findings that you summarized in your chapter with regards to the economic impact payments?
Thanks very much, Wendy. Really excited to be here. And also just want to mention my collaborator, Michael Gelman, with whom I wrote this chapter. And so just quick background on the history of checks and of these types of payments. The US has had these payments not just in 2020 and 21, but there also been a little bit of history before. The magnitude of these checks has been increasing over time. In the past, they had been about 15% of monthly income for a family of four. That rose a little bit back in 2008. This time around, the payments were much bigger, as sort of some of the earlier discussion that you alluded to had mentioned, where we're seeing payments around 40% of income and even 60% of income with a third round of monthly income. So it's a lot bigger than in the past, right? Looking in our chapter, we looked in survey data to see what was happening with households and using them, and particularly the lowest income households, not surprisingly, the ones that report using these to help address the immediate needs of their family, like in the last week when they've been surveyed, right? And also in reviewing the literature more broadly, in terms of mitigating earnings losses, unemployment insurance certainly helped the lowest income household, as Fiona was mentioning, but also economic impact payments actually played a pretty substantial role as well in offsetting large earnings losses among families. Right, so a lot of, these were very broadly based. They were fairly high income thresholds. Many families, many households report receiving the benefits, right? But it still turned out one of the downsides was that a lot of eligible households still had not received payments. So even though we've moved to a very automated world and getting things dispersed electronically, versus the earlier payments I mentioned were coming via check, the GAO still found that 9 million individuals had not received payments as of mid-September of 2020. And so, it did a lot to inject cash into the economy very quickly, and families were getting payments really quickly, but there still were some fairly vulnerable households that didn't get the checks right away. And hopefully that's something resolved in the longer term. With the second and third round, once those families had signed up, they were also able to get rounds 2 and round 3 pretty quickly, right? But that initial round, it was really challenging for a set of households. In terms of the impacts, the impacts, it turns out, were somewhat similar to what we've seen in the past with the other rebates that I had mentioned before. So economists like to use the term marginal propensity to consume, short for MPC. It's, if I give you $1, how much of that, what fraction of that dollar you actually spending, right? And so the MPCs range between 0.25 and 0.5. What does that mean? Basically, if a family gets $100, they're spending between $25 and $50, right? The magnitudes that we're seeing are fairly comparable to what we had seen before. Something new this time around, right? From those earlier studies and earlier episodes, now researchers have access to things such as transaction data. And so we can see exactly when families are spending their income. And we saw that in the first few weeks, we see a lot of money being spent right away when these needy households are receiving things. That's something we may come back and talk about a little bit later, because we know other benefits may take time to arrive, and these stimulus payments can come and be used, in that intervening period before other types of benefits can be rolled out, right? And so we saw that, we had a few lessons that we also drew in this chapter, and the first one was precisely this: now moving away from paper checks, moving to using direct deposit and other ways, we're getting the payments out to people very quickly. They can, give the money to the households very quickly, and in turn, the families are able to inject cash into the economy very quickly, right? In a normal recession, we see this lack of demand, and we're trying to offset a lack of demand. Things were a little bit different this time around, of course, because with all the shutdowns, we see this fall in demand, but the inability to say go purchase particular goods because my favorite restaurant isn't open anymore, or other things along those lines, right? Another lesson that we saw is thinking about whether the payments that are made are well targeted. Are we hitting the right households? Really depends on what we want to do with the money from the policymaker's perspective, right? So we kind of go over 3 issues, but we really focus on the first 2. One is, of course, in the households that have lost income, they become unemployed, for example. Getting money to them very quickly makes a lot of sense, and of course, policymakers might want to do that. On the other hand, another reason that was mentioned a few times early on with the first round stimulus was just insurance, right? We don't know what's going to happen. It's great for families to have money there, so something bad happens, they can use it. And precisely when things got worse, having the money in their bank account to be able to respond, while you're trying to file for unemployment, turned out to be very important. And another point is also stimulating the economy, as I mentioned before. That's a pretty big issue. A lot of people focus attention on there. In our chapter, we really were focusing on the household, not necessarily, were firms staying open and what's the bigger, broader economic impact there. But, in thinking about targeting benefits, what the policymakers want to do we want to give cash to low-income households that are most likely to have lost their job, versus do we want to have money for all households? Because if all households are spending, they can inject cash into the economy and help stimulate it. Whether you want to target things really depends on what your motivation is. Right. As I also alluded to, we had 2 more policy lessons very quickly. One is our ability to fill holes that are left by other programs. I mentioned the timing is really one. As you alluded to in the introduction, Wendy, this idea of potential automatic stabilizers, you can imagine that if we said, well, things are getting bad, we're going to give families cash so they can inject into the economy. Perhaps that's something that policymakers may want to consider while people are still taking time to find the right program to enroll in. Do I enroll in TANF or SNAP, or do I enroll for UI? Right? If there's something that comes directly to your bank account and you can spend right away, that may help offset things in the very short run. Right? And finally, the other thing we did learn is there's a lot of very interesting interactions between all of the various social programs, and it's usually very hard for researchers to dig into that, because a lot of time what we know is about, people might be surveyed about the EIPs that you received, but maybe they weren't asked questions also about other government programs. So the ability for researchers down the line, and again, at the beginning, I said, we're tired of just saying we need more data, but this truly is a situation. So my last comment is we do need to have more data here, because I think we can learn a lot more about the interactions among all programs at the state and federal level to help understand how we can better serve families in the next recession.
Yeah, and so before I ask you, Fiona, about what lessons you take for policymakers, I just want to follow up, Mel, and say, yeah, it was extraordinarily frustrating as a spectator watching you try to work through whether or not the checks really provided that insurance that we hoped that they would, whether or not that they were really getting to families that either didn't have access to other fiscal support, or the access to fiscal support that they had wasn't sufficient. And it's remarkable that we actually don't know the answer to that question, concretely. So we hope that that's what checks did, but we need more data to know if that's really how they were most effective. But so Fiona, I'm going to assume, since Mel's not wildly waving, frantically, but I basically got that takeaway correct. So Fiona, tell me what lessons you take from your work for policymakers in the future.
Yeah, well, one thing I really want to underscore that comes through, I think, in both what Mel is saying, what our experience was, is that, as economists, we tend to think about the economics of policy and perhaps not enough about the plumbing of policy. And, you're hearing from Mel, look, these payments can be fast. That is actually about the plumbing, and the plumbing improved. We went from sending checks to delivering things electronically, and that'll only, continue to accelerate. And so some of the key lessons around, UI do relate to the plumbing, not just the economics. But if I take the economics first, because, right, we did actually do something very economically, conceptually quite different, right, with these huge, the supplements, the extensions, et cetera, I think there is a real question as to whether we might want to consider adopting some of these expansions more permanently, or as some automatic counter-cyclical stabilizer, right? We do have a framework whereby, states extend the duration of their state benefits, under certain economic conditions. Our federal standards around that still require, federal action to even just to extend duration. And of course, the increase in the levels and the eligibility, those were whole new, programs that were legislated, or had to be decided upon at the time. If we think about the level of benefits, I think there's a case to be made that, we might think about increasing these, or encouraging states to increase these even in normal times, right? We have replacement rates that vary across the states, but they hover, around 50%, which is low by international standards. So bringing them up to the 60 to 70% could reduce the consumption drops that we see in normal times, but of course would provide more income support, especially in a future recession, if we didn't want to implement supplements that more than replaced income. Now, one sort of plumbing issue that came to a head during the pandemic was that we were actually unable to target a replacement rate, right? We were not able at the individual level to say, I want to replace 100% of your wages pre-job loss. And that was a technological constraint. Across the states, some states were able to could have done that, other states couldn't. And so we really didn't have the systems in place that would enable that kind of individually tailored replacement rate approach to the supplement. So, were we to have that, you could say, hey, let's peg that at 60 or 70% in normal times, but we could increase that, right? If we were to face circumstances like we did during the pandemic. On eligibility, there too, I think there's a question as to whether we might consider more, sustained expansions in eligibility. I think we were asking a lot of states to stand up a whole new program. I think I think the standard is like, normally when the Department of Labor issues new guidance, states have something like 2 years to fully implement such new guidance, and yet they were being asked in a matter of days to start a new program. And so those operational difficulties alone, I think, warrant consideration of more permanent adoption of at least an eligibility framework that would contemplate some of these edge cases that came in, right? Individual, independent workers, contingent workers, sort of good cause scenarios, right, where people have lost the breadwinner in their family, and other circumstances that really became very salient during the pandemic, where it was, very understandable that we would want, as a policy, as a policy goal to provide income supports to people who could not work because they were sick, or could not work because they were caring for sick, right? Like that is now we're edging this into a narrative around, paid leave and paid leave, sick leave, of different sorts. So all to say, now the figuring out the nuts and bolts of it, how to define this, who's eligible, how to verify income, how to mitigate against, moral hazard, even as we did discover that we thought it was pretty low. I think those are questions, but there are questions that should be worked on when we're not in an emergency, right? And they can't be kind of sorted out in an emergency and then left, then those insights sort of left to wither, right? And that's the sense in which I think this is a problem that we should continue to work on and continue to sharpen that eligibility framework to contemplate some of these expansions on a more durable basis. There's a whole other set of policy lessons that I think really are around the administrative aspects of UI, and thinking about how to sort of push the frontier of what's possible in terms of doing things fast, but also doing things accurately. And I think in order to push that frontier, we really do need an investment in technology, an investment in modernization, in an ability for states to share with each other and with the feds any number of data sets that can help verify whether you're already receiving UI over in this state, or whether whether you are deceased as per this state's records. But all to say, I think one analogy that came to mind as we were closing out this work is that, what we experienced was, an economic emergency, right? Which will happen again. And not unlike a hurricane or, that FEMA has to respond to. And when FEMA responds to a hurricane, they're not learning how to, build shelter. They just go do it, right? And I wonder if we might think about that sort of disaster preparedness mindset as we modernize and strengthen and take forward the lessons from this UI experiment in terms of how do we become how do we create a policy that is recession ready, emergency ready, work centered, and we did extraordinary things during the pandemic along those lines, but perhaps we can do it in a little less bootstrapped way the next time around.
So this book is definitely meant to create some of that urgency around doing things now. I just want to follow up on one thing, Fiona. You mentioned a couple of times replacement rates of, let's say, 60 or 70%, and suggesting maybe those should be increased when the economy is really weak. Can replacement rates be too high? They were obviously much higher than that for a lot of households, for a lot of unemployed people during the last, during the expansions. Are there equity issues? Are there incentive issues?
So yes and yes, right. We definitely saw larger work disincentive effects for lower income workers for whom that replacement rate went up to 150%, right? Than workers who had lower replacement rates. So yes, I think the replacement rates can be too high, and the higher they are, it is creating an incentive for workers to rather stick around and hang out on UI than to try to get a job. So I think they can be too high. And your other question was about equity. And I think the other risk of replacement rates being, exceeding 100% or even at 100% is that, and it was really salient during the pandemic, my heart was pouring for the essential worker, right? Who had to go to work, who I was relying on to go to work, who, and it, I know in my own heart, sort of a sense of inequity that this essential worker over here was getting paid X, and this non-essential worker, but, immediately displaced worker over here was getting 1.5X, their pay. Even if they were normally, similarly paid workers. And so I think that horizontal equity was something that really came to the fore here. And replacement rates above 100% do, I think, rub against that.
So Mel, I'd like you to talk a little bit more about what you found with the, as you call it, marginal propensities to consume over time. Like, was the first round of checks different from the second round of checks, different from the third round of checks? I know we don't know everything there, but what do we know?
Thanks. So when we started putting together this volume, most of the information that was out there is about the first round of checks, right? So there's a little bit more about the second and third rounds that emerged. It turns out that across the rounds, the MPCs didn't vary too much in terms of what we're seeing. That is, you give the family, $100, they're going to spend $25 of it. That didn't vary a lot. Some very interesting work. And so there could be a question as to why that is the case and what did we learn for the future. Fiona and her colleagues in a different, some different work show that looking at bank account data, you see this big increase in savings. So the lowest income households, you see their account balances going up by roughly 100% after the first round of EIPs. Then you see them falling down. Then you see it go back up when the next round of EIPs come in. But you still see through December of 2021, after all three rounds are out there, you see among the lowest income households, you still have, I'd say in the ballpark of like 70% or 80%. Fiona can correct me. She knows numbers way better than me. And so there's this big question of, is this a little bit different in terms of other recessions? How do we extrapolate things out? Because families had so much money in their accounts, right? And so maybe we see some drop off over time in terms of the MPCs. It's hard to say because we had little information on rounds 2 and 3 to see. If there was a drop off, it perhaps could have been because families had more money in their accounts relative to what we might normally see. But that was the biggest thing that we saw, was this really stark increase in saving. That was, I think, probably surprised a lot of people. I'm guessing Fiona's probably surprised because we anticipate a lot of families going out and spending those checks when they're getting them, especially at the lowest level. But this time around, there's a lot of uncertainty out there. There was a lot of closures, and so people may respond a little bit differently than they normally have in the past.
So I think I want to make sure I get this number right. Let's see if I can do this without putting my glasses on. I'm not sure that I can, but that I think you find that a family of 4, a typical family of 4, maybe would have gotten 11,400. I think I'm remembering that number correctly.
The number's right over all 3 rounds. That's right.
Over all 3 rounds for sure. So I guess a similar question in spirit to the one I was asking Fiona about replacement rates. How should we think about how big economic impact payments should be relative to income? Like, were they, because I completely appreciating that these were over 3 rounds, but cumulatively, it was a great deal of money. That's, thinking about your monthly income benchmark, it's 125% of monthly income for a typical family. So how should future policymakers think about how to size these checks?
Right.
If
Sorry. Yeah, no, it's a great point. Yeah. It's a great point. And I think, there's, from a research perspective, there's just been very little research on this because usually the payments are one size fits all, right? So we don't have a lot of great information, except for the fact that, on the other hand, we could do this as a share of your household income, right? So of course you have a one size fits all payment. Higher income households, it's a lower share, but they're also, you typically have higher savings. So discerning, the difference between, is it more income, is it a bigger payment, is always, I think, a challenge. Was there too much income, stimulating the economy this time around across all 3 ways? I don't think, from what we saw, if we, can really answer that. I do think it is something that is, useful to think carefully about, right? I mean, again, the families that had saved a lot of money, again, going to these, the figure that was presented from Fiona's work in our paper, there's a lot of uncertainty, I think, that still remains, and for families to have the ability to draw on that. And going back to the question early on, is it about to fix the immediate need? is it about insurance, right? Because if it is about insurance and this money is playing an insurance role, that could be really vital when other things are happening that could compound because, okay, now I found a new job, I can just barely get by, but what if I lose that job? Or what if someone else, the second or third person in the household who's helping us pay the rent, they lose their job? Well, having that money in bank accounts could be really helpful. So it is a complex situation. And, from what we examined, we really only focused on, how much are they spending? But I really appreciate this question of how big should they be? Because I think that's something that we're going to need to struggle with going forward. And very much in line with what Fiona was saying with UI payments.
So one of the hardest things I think we asked you both and all of the authors to grapple with was how much of what we saw in terms of the effects of these policies over the last 2 years was unique to this being a pandemic. So we can't extrapolate from this experience going forward. And all the ways in which things were unique because of the pandemic, both because of the ways things shut down, but then because of the ways that things bounced back faster than they might in a next recession, and certainly than they have in previous recessions. So that was just exceedingly difficult, but incredibly important for policymakers in the future, because we don't want them to look at policies that were particularly successful in this context of a pandemic that might not be successful outside of a pandemic and, in a normal kind of recession, and vice versa, policies that weren't particularly effective, but only because it was a pandemic, and they shouldn't just ditch them. So I want to ask you, what were economic effects that you saw of both UI and the economic impact payments that you thought were specific, or at least you had to do some work to tease out how much this was pandemic or this recession was special, and that influences what I think in terms of the lesson going forward? And I mean, Fiona, I think this is—
Yeah, I can jump in here.
So UI is all over this in terms of the incentive effects.
Yeah, no, exactly. I think the spending effects is robust and will probably repeat itself right in the next recession, because UI, targets people who are in a low income state, but it really was the work disincentive effects which were low, and we spent a lot of time and continue our working on this question. It's like, okay, well, why were they low? And we've put down on paper a number of possibilities. Initially labor demand was low, well, but then in 2021 it was high, and so you kind of rule that one out, because even when labor demand was roaring back and we had a worker shortage, it seemed like work disincentive effects were still low. Second possibility is this high savings rate, and the cash buffers that we saw did grow. Obviously that gives families the feeling that they have more time. It's not an emergency that they have to go back to work. They can wait for a good job, or wait for a higher paying job, or they may be in transition, and so that liquidity could have helped them, or caused them to feel like this is an emergency. A third thing is that in the pandemic, a big share of people returning to their jobs were returning to their old employers. A large share of people returning were being recalled in effect, right? And there was policy that was promoting that, right? The PPP, et cetera, like get these backers back to work at their old employers. And so insofar as high recalls, there the decision to recall sits more with the employer, not necessarily just with maybe that's why we didn't see as strong of a work disincentive effect, because actually, well, the vast majority of people were just going back to their old employer. So that's another thing, but I do think there are a whole set of very pandemic specific factors that could have been playing a big role, right? Childcare constraints, even just the volatility of whether my child is eligible to go to school because they might have been exposed or what have you, right? Healthcare concerns. I personally am not ready to go back and be a bartender. I don't want to be exposed. I have people at home. I have myself, my own health to worry about. So I think thinking about the ways in which the public health environment, the concerns around one's own health, the barriers to work that were pandemic related, either because of supply of childcare or because of volatility of eligible for childcare, were also really important. And so we are in the process of trying to ferret out, how much of this is really just pandemic related, or weren't. And then, if we can ferret it all out, then you got to start to wonder, well, what about all those 18 studies that showed much higher job distance effects? Maybe we should be asking ourselves whether there's a historical publication bias. Who knows? So to me, this is very much an open question, Wendy.
And Mel, maybe one way in which, as I'm thinking about this really, I'm happy to hear anything that you want to say, but it just, from my perspective, one way in which this probably influenced your thinking of the empirical effects is that in past rounds of rebate checks, like in previous recessions, we did things like we just looked at a particular kind of spending, like spending on non-durables or, like a small slice of spending, and then just assumed that it was a good proxy for all spending. And this time, I think you guys worked a lot harder to think about, well, but let's include durable spending. Let's think about goods versus services, and like the mix of spending could be so different. So like that's one way in which I think the pandemic influenced the way you approach this problem. But A, maybe you think that's wrong, and B, what other things do you have in mind?
No, Wendy, I think that's right. You have to, think very carefully, especially in the pandemic, about the effects, many of which Fiona had just gone through. I was just thinking about, as Fiona was talking also about the fact that, having groceries delivered and then spending time wiping them down with alcohol wipes, right? Remember back 2 years, that was the advice that we were all being given. And there's a lot less people eating out at the time, right? And so those types of economic effects truly are, diverting where people are spending their money, right? And so I think thinking about, all categories of spending, because people are doing so many different things. I mean, this recession, as you mentioned, you talked about non-durable spending, so things that usually might disappear in a short period of time, but there were investments in durable goods, right? It was impossible to find a bicycle, for example, for a little while there, right? Or other things that having to do with outdoor activities. And so you really want to be careful in thinking about where were people putting their dollars. So getting to your point about total spending, that's right. It sort of broadened what we think about in terms of where people are putting their dollars, and that was certainly a difference. Again, a lot of this is pandemic related, and so but on the exact same front, next time around, are people going to, is there going to be a big wave of bicycles that are being purchased? Or outdoor pools or things along those lines? Perhaps not, right? And so that's where it's a little bit tricky, because people are making these, a lot of times we focus on decisions for spending that might be over a shorter period of time, but these longer term investments in goods, that really changed this time around. And so just as you highlight, it makes you have to think a little bit differently about what types of measures and outcomes you want to examine. Because that's what makes this one different. Prior recessions, perhaps not so much, right? Usually a lot of the other factors are fairly similar.
Fiona, did you want to jump in?
Yeah, I wanted to jump in with just one other thing. One important theme on the UI side across some of the different innovations was that, normally to get UI, there's actually quite a bit of third-party verification. An employer has to certify that the employee was in fact laid off, or that the employer data is used to check if an employee has received a job offer and gone back to work and that sort of thing. And a lot of that was waived, right? We waived work search requirements. We just relaxed a lot of these employer reporting requirements. And that's just another way in which this episode was different. And I think it raises really important policy questions about, okay, well, we kind of relaxed all of this, and yes, overpayment rates went up, from 10 to 18%. And but it seemed like mostly the right people got this, and that they went back to, they weren't necessarily disincentivized to go back to work. And so I think that raises a question around, like, well, how much certification do we need? What is the sort of cost benefit on a lot of this red tape that we have in place? And should we rethink that? Can we modernize that in a much lighter weight approach that allows more people to get access to these benefits and increase the recipiency rate, particularly for Black, Latinx workers, low-income, workers who have been left out of this system and are uninsured or unsupported by the system, and enable that access to increase even within the bounds of what we consider to be eligibility.
Well, thank you. We have to leave it there. Thank you very much, Mel and Fiona, for participating today and for the many hours of hard work leading up to today. And I encourage everybody to read these chapters. And I hope that this discussion provides, the intention is that it provides a really good foundation for the discussions for the remainder of the event today, where you should keep in the back of your mind that this enormous fiscal support worked in concert with the other policies that we will be discussing. So with that, I'm going to turn it over to my colleague and co-editor, David Wessel.
Thank you very much, Wendy, and also to Mel and Fiona for such thorough examinations of their chapter. One of the things that made this project challenging is that the government did so many different things. And as Wendy pointed out, it's hard to think about the whole without thinking about the pieces, but it's hard to see what the pieces did independently without thinking about the whole. So we're going to try and take a stab at that in the following panel. I'm joined by Anna Azar of Brown University, who wrote a chapter focused on what we did for families with children, with Laurie Goodman of the Urban Institute and Paul Willen of the Federal Reserve Bank of Boston, though he speaks for himself and not the Federal Reserve, who looked at housing. And then my Brookings colleagues, Louise Shaner, who looked at state and local governments and how that happened. So I want to start with you, Anna. We know recessions are hard on people in general, and the effects on children can be particularly serious because they can be long-lasting. And I think we did a lot with that in mind this time around. The economic impact payments that Mel talked about, for instance, had extra money for families with children. But in general, what did we do that benefited children in particular? And what do you think worked well and what didn't?
Thanks very much, David. That's a great question. So as you noted, we know from recent evidence that a negative event in a child's life, even if it's relatively short-lived, can have pretty significant long-term consequences in terms of that child's healthy development, their school performance, and even their future success in the labor market. And that's why it's so important to provide relief to families with children during negative events like recessions, because the consequences can be so long-lasting. And so what worked well is your question? Couple of things. Children are the group most likely to be living in poverty in the US. They are in the households with the fewest resources, who have the hardest time weathering recessions. And during this recession, a lot of financial assistance was provided either directly or indirectly to families with children. They were directly targeted through the child tax credit, and to a lesser extent, the EIPs, which they weren't exclusively for children, those payments increased with the number of children in the household. And children were also indirectly targeted through aid that was provided to those individuals with less attachment to the formal labor force. And so this includes not only the stimulus payments, but also the UI program, which during this recession offered relief to many more groups not previously eligible or eligible for very much smaller amounts. So independent contractors, those who had worked fewer hours, and these tend to be the lower income families, often families headed by women, and therefore very much indirectly targeted children. And of these sources of financial support, the stimulus payments, UI, food stamps, and the child tax credit were all incredibly successful in getting more resources into the hands of the most vulnerable families with children. To get a sense of how successful, the first two rounds of the EIPs were estimated to have lifted 3.2 million children out of poverty in 2020. The UI program lifted an additional 1.4 million children out of poverty. SNAP, 1.3 million. And the refundable tax credits through the EITC and the CTC, another 2.7 million children out of poverty in 2020. And you can see from the data that when these payments go out and reach households, you see reductions in food insecurity in households with children. So it is working, right? So it was helping to sort of stabilize the environment for low-income children. And I want to mention, one last thing, and this echoes comments that Fiona made previously, which is that there were all kinds of concerns about sort of negative incentive effects of providing cash assistance, income assistance that was not conditional on work, right? There was huge concerns that this was going to depress labor supply, that fewer people will return to the labor market and work because of this. In fact, we have recently found the child tax credit, there was no such effect. It did not at all suppress labor supply in families that received the child tax credit. So that's, I think, very important to keep in mind for future recessions. What didn't work well? Okay, couple things. Some groups of children were left out in the first rounds of the economic impact payments. Children who were US citizens but lived in households with adults without an SSN were not eligible for the stimulus payments. There were about 4 million children in this group. It also excluded 17 and 18-year-olds. Should be noted, though, that in 2021, the American Rescue Plan did make those sorts of corrections, and those kids were folded in to future stimulus payments. Another thing that didn't work quite well was the relief for childcare centers. There was a lot more relief provided during this recession relative to, say, the Great Recession, but it came too late. And why do I say that? The thing about childcare centers is their finances are quite precarious. Based on surveys of childcare providers, they can last maybe 2 weeks if there's a significant reduction in their revenues. And so what we saw was that many childcare centers were forced to close, and many have been unable to reopen. So if we want to provide support to childcare centers, we need to do it early. Otherwise, we have the problem, which is that once the recession starts to evolve and labor market conditions strengthen over time, it may be the case that many working families are unable to return to work because they are no longer able to access childcare because their childcare center has closed. So that was one thing we didn't get quite right. Finally, the last thing is we need better data. There was the household pulse data, which was an attempt to sort of get real-time data on the situation of Americans during the recession, but there were very few child-oriented questions in those surveys, very hard to get a sense of how children were doing. And then some data was just missing altogether. Childcare data, again, big hole. We really do not have a good way to sort of track families' access to childcare, and that is a real problem. So going forward, those are some things that policymakers should think about.
Great, thank you. And I also want to thank you for, if you want to talk about children, having children's art behind you seems a very good idea. Well done. So we want to now turn to housing. And what we did is we divided our housing chapter into two parts, renters and homeowners, because they really are quite different. Just to set the stage, going into the pandemic, there were 123 million occupied housing units in the United States. Of those, 44 million were rented and 79 million were owner-occupied. But 2/3 of those owner-occupied had mortgages. 1/3 had already paid off their mortgages. And of course, their circumstances were very different. very different between the two groups and very different than in the Great Recession of 2007, 8, and 9. So Lori, let me start with you. Basically, what did we do for renters?
My chapter was co-authored with the wonderful Susan Wachter, who's a professor of real estate and finance from the University of Pennsylvania, and I want to acknowledge her huge contribution. Let me first set the stage. So it's important to realize that renters are less affluent than homeowners. They have lower incomes, lower wealth, and were disproportionately hit by COVID-19. Also, going into the pandemic, 3 out of every 4 families that qualified for federal assistance didn't receive it due to budgetary constraints. 46% of all rental households spend at least 30% of their income on rent and are considered cost burdened. Nearly a quarter spend more than 50% of their income on rent and are considered severely cost burdened. During the pandemic, homeowners benefited from rapid home price appreciation, whereas renters faced rapidly rising rental costs. So there are 3 types of assistance available to renters: direct cash assistance in the form of enhanced unemployment insurance and economic impact payments, eviction moratoriums, and emergency rental assistance. The enhanced unemployment insurance and economic impact payments were largely sufficient to ensure the moderate and higher income renters who lost their jobs didn't fall behind on rent. That is, the income replacement policies were sufficient if policymakers were concerned only with the incremental effect of the recession on those that were employed in the formal economy before the recession. We saw this in the data. There is virtually no relationship between increases in unemployment and increases in renter delinquencies. By contrast, lower income renters did show signs of increased distress. For renter households that were housing insecure before the pandemic, many without formal labor force attachment, the income replacement was insufficient. The eviction moratoriums were absolutely necessary to contain the health crisis. It was particularly valuable to those families that were already strained coming into the pandemic and were then adversely affected by the pandemic, perhaps losing hours at work. Many of those renters had few alternatives. They could move in with other family members, which would have created more overcrowding, or become homeless. There's no doubt the eviction moratorium reduced the COVID-19 infection and death rates, resulted in the redirection of scarce household resources to immediate needs such as groceries, which reduced food insecurity and prevented homelessness, because after all, the rent always eats first. However, the cost of this moratorium was largely borne by landlords, which had negative consequences for the tenants going forward. In particular, many landlords deferred maintenance on their property and tightened screening criteria for new tenants, which will leave a legacy in the market for a long, long time to come. Emergency rental assistance, which would cover utilities, rents up to 18 months, and some amount of future rent, was very valuable to lower income families. Those under 80 AMI were eligible, and many of those families were strained going into the pandemic. The ERA funds were done in a very disjointed fashion. That is, they're done in the form of grants to states, territories, local governments, and Indian tribes. Grantees, many of whom had not done this before, were each required to set up their own programs to distribute the funds. The funds were first authorized in December of 2020, with another slug in March of 2021. By December of 2021, only 44% of total funding had been spent. A quicker, more streamlined rollout would have been very beneficial for tenants and would have reduced the costs of the eviction moratorium for landlords. So together, these programs largely compensated for the losses associated with the pandemic, but they didn't address the long-standing problems of the housing market insecure segment of the population. And then I want to echo a point that Anna made: data. The crisis also highlighted the need for better data on renters and renter market conditions, both delinquencies and evictions. The lack of pre-pandemic data made it difficult to disentangle the effectiveness of policy responses, and much of the pandemic data is ending as the pandemic winds down. We need to collect this data on an ongoing basis.
So Lori, you say that UI payments and economic impact payments were basically sufficient for people to pay the rent. And then we had an eviction moratorium. And then we gave, although as you point out, not very efficiently, assistance to people to pay their rent. So when you look at that combination of things, what do you think was most important? And did we kind of overdo it, do you think?
I mean, I think there's been a lot of discussion as to whether, we needed the full extent of the income replacement, but certainly, did we need the entire last slug? But certainly it worked very well. I think the emergency rental assistance could have been rolled out much earlier, and ideally that would have been rolled out much earlier and less reliance on the eviction moratoriums. Because if you'd implemented the emergency rental assistance quickly and efficiently, it would have made a big difference. I mean, and I want to emphasize efficiently. I mean, the programs, everyone had their own set of rules. Some of these programs had very cumbersome, some of these programs had extremely cumbersome documentation requirements. If they were streamlined programs, simple application, minimal documentation, clear eligibility rules, similar to the forbearance program that I know Paul's going to talk about, it would have made a big difference and would have allowed the eviction moratoriums to be much, much shorter.
Right. I think it's really interesting because you're echoing a point that Fiona made, that we stood up some programs in a hurry during the pandemic. And if we think they worked and we're going to need them again, the time now is to craft them and perfect them as best we can. So we're not inventing them on the fly at the same time we're pushing out the money. I thought also that your chapter really reminded me that we have a problem with renters and their house having unacceptable burdens before the pandemic. And so I think what this did is highlighted for us how vulnerable many rental households are. And I think what you said in the chapter is we did a lot to help them, people who needed incremental help during the pandemic, but we're left with this same longstanding problem of inadequate housing supply and inadequate supply of affordable housing.
Yes, a more permanent safety net that captures more of the population would have been it just shows the value of that. That way, in a crisis, policymakers could focus on the smaller share of the population that falls through the cracks.
Great. Okay, let me turn to you, Paul. Of course, there are many more homeowners than there are renters. And we learned during the Great Recession that sometimes homeowners can be particularly vulnerable when we have a crisis in the economy. That wasn't true this time, in part because people came into the pandemic with more equity in their homes and also because house prices kept rising. But as you step back and look at what did we do for homeowners with mortgages, and what do you think of it? You need to unmute, Paul.
Thank you, David. I want to reiterate that I'm here today as a researcher and as a concerned citizen, not as a representative of the Federal Reserve system. So when I say we, I am not referring to me and Jay Powell. I'm referring to me and Chris Girardi and Lauren Lambie Hansen, who are my co-authors, who are also researchers and concerned citizens who happen also to work for the Federal Reserve system. So, and let me also just say how happy I am to be here and how much I have learned from putting together my own paper and from seeing all the other work. So to answer your question, it is very hard, especially for someone like me who lived through the last crisis, not to view the pandemic and housing through the lens of 2000 of the financial crisis. And so let me just briefly talk about what we found. So the forbearance is kind of the central story in our policy response, and it is very easy to compare it with what we did in the financial crisis, and to compare it favorably. So forbearance worked very quickly. Borrowers were getting assistance basically in April. As you know, the pandemic started in March, or the effects of the pandemic on the economy started in March. We're already helping borrowers in April. Remember, just as some context, the home affordable programs, they weren't even announced until February of 2009, and the crisis had started in 2007. Forbearance was easy. So we all remember or many of us remember in the financial crisis, what a bureaucratic nightmare all of the government programs were, and how it took several years in some cases to roll them out, and then months for borrowers to get assistance. By contrast, forbearance worked, it required no verification from borrowers. All they had to do was call their servicer and attest to hardship, and they would receive forbearance. And finally, forbearance is efficient in the sense that because the borrower, for the most part, is expected to repay the money, it's incentive compatible, and that's one of the reasons why it was so easy and so quick to implement. Because since the borrower has to pay the money back, even on what turned out to be very generous terms, it means the incentive for someone to fake a need was limited. So that's all the good parts of forbearance. I'm going to come back to this, the bad parts. Let me also just discuss another policy response, which was low mortgage rates. And we had partly through policy interventions, we had the lowest mortgage rates, for all practical purposes in history. And so we might think that helped borrowers a lot, but what we show in the paper is that was very slow to diffuse. Unlike forbearance, which happened immediately, it takes time for borrowers to refinance their mortgages, and it diffused very slowly. It was inefficient in the sense that an enormous amount of money went not to borrowers or to lenders, but to the intermediaries who arrange the transactions. And that happens whenever we have lots of refinances, and it's one of the reasons why mortgage refinance is an inefficient way to help people. But we also highlight that the benefits of low interest rates were very poorly distributed. So they tended to go obviously to people with big mortgages, but even more than that, there was huge racial heterogeneity in the benefits. So we show that the Black households, for example, are 15% of the population, but they got about 3% of the payment reductions from low interest rates. And so let me just conclude, though, in saying this all sounds like I'm saying forbearance would have been a panacea in 2009, but it will be hard for us to generalize the experience because we, of course, had two things in 2009, in 2020 and 2021 that we didn't have in 2009. And one of those, of course, the main one being that house prices were rising rather than falling. So borrowers had a strong incentive to maintain their home ownerships, which they didn't have in 2009. And finally, of course, the economy recovered so much more quickly. Now, maybe that was itself the result of all the more sensible policy, but of course that meant that the benefits of that forbearance is something that worked because borrowers could eventually pay back their mortgages, and because they had an incentive to, because they had equity. And it's hard to know whether in the future that will be something that we face. David, I think you're muted.
You're absolutely right. So forbearance, meaning that people didn't have to make their mortgage payments for something like 18 months. Were you surprised at the number of people who decided not to take advantage of that, given that it was pretty easy to get?
No, I'm muted. So the, there's links to the, again, it's really hard to avoid discussing the unemployment insurance and the income support programs. So one of the concerns we had early on about forbearance was that it was going to bankrupt mortgage servicers. And so mortgage servicers receive the mortgage payments from the borrowers, and they're also responsible for paying the investors. But the rules are that they have to pay the investor regardless of whether the borrower makes the payment. So there was a lot of concern that if the borrower stopped making their payments and the servicers had to continue making their payments, that the servicers would go out of business. And so we were quite alarmed about that. But I think once we learned that about the expanded unemployment insurance, I think a lot of our alarm at that point subsided, because we thought in the end, there are a lot of the borrowers who we thought, who had lost all their income, who we thought we were going to need forbearance, ended up not needing it. So I think we probably were maybe pleasantly surprised at how few, that the problem wasn't worse, but not completely surprised, no.
Okay, thanks. All right, let me turn to my colleague, Louise Shaner. Louise, you focused on state and local governments, which I think people sometimes fail to appreciate how big they are in our economy. It's about 13% of all employment in the United States, and their revenues are about half the size of the federal government's revenues, which are substantial. So when we went into the pandemic, based on experiences in past recessions, there was almost a panic that state and local governments' revenues would evaporate. Why didn't that happen this time? And how much money did we give these governments? Anyways.
Yeah, so I think that's exactly the right way to frame it. So coming into the pandemic, we had come out of the Great Recession, where state and local governments had suffered huge revenue losses and had been a factor really holding back the recovery. And one of the lessons that we had learned from the Great Recession is that you have to give money to state and local governments if you want to have a strong recovery. So that is the mindset we came in. In the spring of 2020, people were trying to estimate what the revenue losses would be for the state and local sector. And there was a wide variation, but they were mostly very, very high, from 600 billion to close to $1 trillion in losses. And so that was sort of the framing of it that went into the CARES Act. So over the course of 2020 and 2021, and it wasn't all in the spring of 2020, we gave state and local governments a lot of aid. When you total it up, it totals close to $1 trillion. Some of that was direct aid, just sort of general aid to state and local governments. And some of that was targeted aid for K through 12 education, for hospitals, a lot of which went to public hospitals, for higher ed, a lot of which to public institutions. So adding that all up together, you get something close to $1 trillion. And so what happened to revenues? So revenues actually really didn't fall at all over 2020 and 2021, surprisingly. They did fall somewhat in 2020 relative to what had been expected, but they recovered quite briskly in 2021. And so if you look at it relative to a pre-pandemic baseline, they kind of came in, as far as we know, exactly where you expect. Why was that? So I think the biggest reason, is something you keep hearing across all of the different panels, is that the recovery was much stronger than anybody had anticipated. So when you're making projections of state and local revenues, the most important thing that you need to assume is what happens to the unemployment rate, what happens to GDP. All of that, the recovery was much quicker than we thought. That's most of the shortfall, but not all of it. The other things, relatedly, were that the housing market did continue to do quite well, as we just talked about. The stock market did very well. Those are all going to be things that boost state and local revenues, and coming both from income taxes and sales taxes, and also the incredible fiscal support. So households didn't cut their spending. They did cut their spending somewhat, but not nearly so much as you would have expected based on the unemployment rate. And finally, this was a very low wage recession. So that meant any rule of thumb from an unemployment rate to revenues was going to be off, because this was a lower wage recession than the typical recession, meaning that the implications for sort of macro aggregates of spending and income were less than you would have guessed.
So, Louise, I think you say in your chapter that, as best you can tell, every state and almost every local government got enough money from Washington to more than compensate for the losses caused by the pandemic, which is pretty startling when you think about it.
I mean, I only know state and local together. I don't actually have information, as we can talk about locales, but I think there was so much money. I mean, so $1 trillion, which is about 30% of 1 year state and local spending, right? So they got a ton of money without losing some states did lose more revenue than others, but still no state sort of lost tons and tons of revenues. And so I think on the aggregate, yes, we basically made all state and local governments whole and then some.
So the real mystery in your chapter is, why did state and local government employment fail to return to pre-pandemic levels? And I know you don't really know the answer, but tell us what happened and what you speculate is going on.
Yeah, I mean, I think it's the huge irony of this experience, which is that after all this money that we gave them, if we say what sectors of the economy are still sort of holding back in terms of employment, state and local is a big one. So state and local employment fell very quickly in the spring of 2020, which is not what happened in the Great Recession. It took a long time for employment to fall in the Great Recession. It fell immediately. It increased a little bit more as the economy recovered in the summer, but really not a lot. And even by March of 2022, it was more than 3% below the level it was before the pandemic. And after a few years, we would have expected some growth. So it really has been quite weak. Why is that? Well, I do, as you say, try to figure it out in the chapter, and there's no real obvious answer. I think the biggest thing has to do with the pandemic itself. And so it's really important to remember that this recession is not necessarily giving you lessons for other recessions, because the pandemic had so much to do with what state and local governments did. So in the spring of 2020, think people who were laid off, bus drivers, cafeteria workers, office workers when the offices were closed, all the office closings, those people were laid off. And then they were sort of slow to return. And if you try to understand, it's hard to say it was money, because everybody eventually got so much money, right, that they didn't use it to hire people back. There is some evidence that sort of so state and local governments that were worried about money sort of right away when they didn't know they were going to get into this aid, and they imposed hiring freezes, they didn't lift those very quickly. That had something to do. So I think money would have made some difference. But another very big predictor of the changes in employment across states is really how concerned they were about COVID, right? And the way I look at that is look at vaccination rates. States with high vaccination rates were more concerned about COVID. They were more likely to have remote school. They were more likely to have their offices closed or only open part-time, or with social distancing, and so their caseloads were lower. They were more likely to do remote work, and I think that means both that there was less need for people, but also just that there was stress. It wasn't necessarily budgetary stress, but the idea of sort of expanding a program or hiring people or being innovative about how you do, school from home. I mean, they could have spent the money in really innovative ways, but I think they basically didn't. And so I think that's a lot to do with it. And then the other thing that happened is then, a lot of the schools were all reopened, basically. They had a lot of money, and sort of job openings did increase a lot in the state and local sector. But at that time, wages had increased so much in the private sector, particularly at the low end, and state and local governments just were not offering those kinds of wages, right? And we can talk a little, if you want, about why they didn't use the money to sort of offer higher wages. But basically, they felt that they did not offer wages. If you just look, if you talk to them, state and local governments are really, really worried about budgets over the long term. So they're really, really worried about doing something now that's going to then change their expenses in 5 years. So this whole idea of you don't want to take one-time federal money to finance something that's going to be ongoing is something that you hear over and over again. And so I think that's one of the reasons that they're not raising wages. They're also unionized, and so they couldn't sort of just have selectively raise wages for new hires. And so, those are sort of my guesses of what's going on. It's hard to know. And obviously, it's not just, there are many, many different state and local governments. And so it's hard to know.
Right. Anna, I think Louise's discussion of state and local governments calls attention to the role of schools at a time like this. Yep. Now, one thing that's clearly pandemic specific is that in an ordinary recession, or one caused by something other than a pandemic, we're not going to close the schools and send all the kids home to work on their iPads. But it seemed to me, and I think you talk about this a little bit in your chapter, we were reminded about how important a delivery mechanism the schools are for reaching poor families. So can you talk a little bit about that and what we think we should keep in mind for the next time, even though it won't be a pandemic?
Yeah, that's a great question. I'm going to answer that, and then I have another comment on Louise's point. So a number of kids, children who are undocumented are welcome in U.S. schools. At US schools, they receive free breakfast and lunch if they are eligible. When the schools close, that means that all of those kids are no longer receiving 2 of the meals they used to be able to count on daily. What the governments did in response to that, the fact that there were so many children, not just those children, but all children were no longer receiving nutritious meals through the National School Lunch and Breakfast programs, they provided this PEBT. The pandemic EBT was essentially a way for families to replace that lost nutrition by, with essentially something similar to SNAP that would allow them to go to the grocery stores. And of course, this went to all children. And so it included those kids who would otherwise not receive any assistance during the pandemic because they were not legally eligible. It took a little bit of time to get going, right? Because it was a new program, but it ended up eventually being quite successful. And because schools serve all children, regardless of their parents' documentation status or their own, that is an important way in which we can continue to serve those children during a recession. The other point I wanted to make regarding sort of Louise's findings is that if you look at the Great Recession, it was followed by pretty significant declines in state spending on schools. It took a long time to recover. That is not going to happen in this recession, in part because of the points that Louise made and the additional funding specifically for schools that was provided by the federal government. So that's a very good thing, providing additional funding for states and local governments so that school spending does not drop precipitously during a recession, which it has in the past, taking years to recover, is a very important lesson from the pandemic, I think.
Thank you. That's a good point. I think one of the things we've struggled with in writing this book and drawing policy conclusions is the fear that policymakers always overreact to the last crisis. So if state and local governments were a problem in the Great Recession, we'll give them a lot of money in this recession, and then the policymakers in the next recession will read Louise's chapter and say, okay, the state and local governments don't need the money. So what I'd like to do in our remaining time is ask each of you, and you can talk about anything you want that's on topic, but I want you each to imagine that we're on the cusp of another recession, which frankly, I think is unfortunately more likely than I had hoped when we began this project. And members of Congress are asking you, what did we do during the pandemic that we should do again or do differently? And what should we not do because it's not a pandemic or because we learned something? And Lori, maybe I'll start with you. What would you tell them?
So I think we did a lot of things right. I think certainly the enhanced unemployment benefit and the benefits and the economic incentive payments were very, very valuable. I think, clearly we need a more permanent system of rental assistance so that so many people aren't struggling all the time. But if we're not going to do that, we have to have a very smooth rollout of emergency rental assistance when it's needed. That means, and this came up in the last session as well, the plumbing has to be in place, which it was definitely not this time. Every grantee was basically setting up their own set of plumbing, which was remarkably inefficient. So, I think my two pieces of advice are: number one, the minute there is any sign of a recession, act very promptly. The prompt actions made a huge, huge difference. A number of people mentioned this. Anna mentioned it in her discussion. It came up in the last session as well. So the prompt actions made a huge difference, and correcting the plumbing on the emergency rental assistance would be my pieces of advice.
It's interesting. Some of the things that you say support the case, which is made in various places in the book, to have more of the more automatic stabilizers, have stuff that triggers on and triggers off that doesn't require an act of Congress to do it. Paul, what would you say we should do again, and what should we avoid doing again? Or is it impossible to say because housing market conditions can be so different every time you hit a recession?
So one thing that is arguably broader than the pandemic itself was that the way the mortgage market worked in terms of the transmission of low interest rates to households, that continues to be a problem. I mean, in the end, most households did not refinance, so did not benefit at all. Those that did refinance paid higher rates, arguably, than they should have, and this is a system where we have an instrument of policy which is to lower interest rates, and for most households the main connection with interest rates is through mortgage rates, and yet most households were unable to take advantage of it, or took advantage of it less than they could have. So I guess we have discussed over the years ways in which we could make this system work better, streamlined refinances. I mean, one of the things that is always funny about refinances is the financial system already has the risk of the mortgage. So there's a question of why we force everybody to treat that mortgage as if it's a new risk to the financial system every time someone wants to get to refinance. And then, as we highlighted, the distributional consequences of this are that the benefits tend to go to the people who need them the least. So the people with high income and large mortgage balances are the ones who get the refinances. So I think the pandemic, I mean, so as I said, in a sense, not everything worked perfectly in the mortgage market. But in this case, it wasn't bad things that happened. It's good things that didn't happen. So I would say that's something that going forward, I would hope we would revisit.
Yeah, I have to say that refinancing a mortgage is certainly painful after you've already bought the house. So are you talking about so the ideal from the consumer point of view would be a mortgage that had a fixed rate, except it could go down and not up? Is that something that's really practical?
I think it's more practical than people think. I mean, we have, a fixed rate mortgage is simple to the borrower, but very complicated for the financial system. So a ratchet mortgage, which ratchets down, sounds complicated, but I think it's something that the financial system could handle, and it's it might require some education or something with borrowers to help them to understand that realistically they're not going to refinance their mortgage when rates go down, and so paying a little extra upfront to have that happen automatically is a good investment. And then obviously all over the world people use adjustable rate mortgages without and they didn't have the financial crisis. So there's always an open question of why we're so resistant to adjustable rate mortgages.
So, Anne, I think you've touched on a number of things, but if you had to highlight something that you think is really important to keep in mind before the next recession, what would be on your list?
Sure. Okay. For low-income kids, cash is king, cash and near cash. You see, for example, food stamps matter. They reduce food insecurity among children, but so does cash assistance. And it's pretty easy to get into people's hands. We learned that during this recession. And the concerns that providing cash assistance will depress labor supply are just largely overblown, right? So there may be some effects, but they are modest at best. And so, we should really not be so terribly concerned about depressing labor supply by providing low-income households with financial resources so that they can weather the recession. Childcare needs help early on, And money for schools, very important. So the feds need to sort of monitor what's happening with state and local spending with respect to schools and provide assistance if needed.
Right. I'm glad you mentioned the childcare thing because I was really struck by that in your chapter. So public childcare like Head Start, they can bump along, they get money. Some kids don't show up, they don't cut their budget. But private childcare is very dependent on the number of kids who come, of course.
That's right.
And then if it closes, it closes. And it's really hard to go back to the pre-pandemic situation. So I think that was like a really, I thought you put it very well. If you're going to give them money, give it to them early, because giving it to the late when they've already closed is hopeless. So Louise, finally, what would your lesson to policymakers be on the state and local sector?
I have a few. So I think the most important thing is don't unlearn the lesson of the Great Recession. Don't say, well, look, money doesn't matter. I think what we learned in the recession and the pandemic is that money is not the only thing that matters, but money does matter. And there is some evidence that money did matter to some extent here, especially because the state and local governments didn't know they were going to get this money. So having aid to state and local governments that sort of a function of economic conditions would have done two things. One, it would have lowered the amount of aid we gave state and local governments this time around because economic conditions turned out better, but it would have also told governments that if things are worse than you think, there will be more aid forthcoming, and so you don't need to worry as much. So I think putting in those kinds of automatic payments to state and local governments would be a good thing. I want to comment a little bit on what Anna said. So it's not clear. I don't think you can conclude that we made a mistake giving so much aid to local governments. I think you can say we gave them a lot more than they had lost, and they didn't use it for employment. And so if the whole point was to make sure they didn't drop employment, it didn't work. But when we think about sort of how we talked about in the first panel, did we do too much? I think that, state and local governments really do spend the money quite slowly. We don't have great data on how much their spending it is, but it's pretty clear that they do spend money slowly. So they are probably not the sector sort of most responsible for this sort of surge in aggregate demand and inflation. And so if, as Anna pointed out, what happens is we give them all this money and over the next 4 or 5 years, education funding is actually more robust than otherwise would have been, or it all just depends on what they use the money for. You could have argued that state and local governments were underfunded before, and maybe they will use it for good investments. And so we don't know. But in terms of what you must make sure you do again is make sure that the aid is available if conditions warrant it.
Thanks. I think what this conversation illustrates is really the strength of this project. First of all, we did so many things during the pandemic that it's very hard to remember what each one was. And what this book does is in one volume or one website, we basically catalog everything that happened on the economic policy response. And the second thing we did was take advantage of the extraordinary amount of economic research that's already been done, but who could read 375 NBER papers on the housing market? And so each of these chapters nicely summarizes what the existing work, admittedly preliminary, is. And finally, I think as you can see in the conversation we've had today, we've been very focused on the question of what did we learn this time that we should apply next time so that we can actually do better in the future than we've done in the past. So with that, I want to thank Lori and Paul and Louise and Anna for such a good conversation. And I want to now turn this over to my friend Austan Goolsbee from the University of Chicago Booth School of Business, who's going to take us home with the remaining chapters.
I don't know if you can hear me, but I can't start my video. It says the host has stopped me.
Well, we can hear you, so start talking, Austan.
Okay. Here we go.
There you are.
All right. So that is excellent. Let me just call this up. We've got a outstanding panel that we're gonna think about the findings from these papers and the lessons for future recessions. And I just forgot what the order is. Is Jonathan Pingle supposed to go first? Jonathan, why don't I start with you? I can't remember if you were meant to go first, but Jonathan is the managing director and the chief economist at UBS. Before that, he was at BlackRock. He was at Brevin Howard. He started at the Fed, and you've got some fascinating results in your paper thinking about the interactions and coordinations of fiscal and monetary policy. So why don't you first take 5 minutes and tell us what you found?
Yeah, thanks, Austin. So, it was really kind of interesting reviewing the history and looking at some of this evidence and, cooperation or coordination. It was the case that got a lot of discussion in financial markets as kind of a theme as we went through the pandemic. It was also a period in which the Federal Reserve was reviewing their framework, which generated a lot of related discussions. And monetary and fiscal policy did coordinate or cooperate in a few innovative ways responding to the pandemic, right? So, for one example, by establishing the municipal liquidity facility, the Federal Reserve, tried to backstop access to funding for state and local governments who were financing their own fiscal responses to the crisis. Another example was, the Fed set up in cooperation with the Treasury Department, funded by the CARES Act, the Paycheck Protection Program liquidity facility, which essentially created a secondary market in PPP loans to improve the extension of credit, under the PPP program. By doing so, the central bank, really attempted to make that fiscal policy, more successful. And depending upon the circumstances, those examples could be templates for future policy actions. But what a lot of we ended up focusing on was looking at the market for, Treasury markets, because what was happening in the markets for U.S. Treasury debt was really extraordinary. At a time when the U.S. Treasury needed to place trillions of dollars of new debt relatively quickly to finance the fiscal response, they did so effortlessly and on historically favorable terms. And in the end, we kind of argue that the Federal Reserve played a really crucial role in facilitating that fiscal response by helping to maintain low borrowing rates across the maturity spectrum for U.S. government debt, at the time when the U.S. Treasury needed to finance extraordinary sums in relatively short order. The Federal Reserve purchased almost $2.5 trillion of Treasury debt in just 12 months. And at the same time, many typical domestic and foreign buyers of Treasury debt, really failed to meaningfully expand their holdings during the fiscal expansion to the extent they would have historically or after the GFC, and many not at all. All the while, debt to GDP in the U.S. expanded, by nearly 20 percentage points in 1 year, and without a ripple in financial markets, which, going back through the evidence, just really appears extraordinary. So, in the paper, we walk through the events and the evidence. We consider the estimates of downward pressure on yields from the Fed's asset purchases, and also estimates of upward pressure on yields that would normally be associated with the literature on debt issuance. And overall, one of the things you realize is that the Federal Reserve displayed the ability to shift its balance sheet, very quickly and by an extraordinary amount, expanding reserves in order to purchase longer dated securities, to a downward pressure on yields further out the curve, and both through forward guidance for the funds rate and ongoing purchases keep those yields well contained as the Treasury borrowed the substantial sum. So in going through this, we then end up making kind of 2 points. One is, as extraordinary as it was, we think the U.S. has the capacity to do it again if needed. But the second point we make is that we caution that the U.S. should not take that ability for granted, right? It depends on our fiscal outlook. And we also argue that it depends really crucially on, keeping and protecting this sort of independent and credible central bank, that maintains credibility for keeping inflation low and stable and maintaining, correspondingly low inflation expectations. So, we think of these as being sort of crucial elements for the Federal Reserve being able to sort of step in and play this role again and sort of run this experiment a second time. I think you're on mute.
Let me just ask you a little more detail on that. The Fed, of course, argues that their asset purchases and everything that they did they were just trying to promote market functioning and some accommodation. They definitely don't view it that they were financing the fiscal response, let's call it. Is that what you're arguing, that they were financing it?
No, not directly. And this is our paper is not really about we can talk about monetizing the debt sort of separately. That's not really the issue. I mean, what we're saying is that yes, at first the Fed's purchases of U.S. Treasury bonds were meant to improve market functioning, right? In March of 2020, the Treasury market seized. Overseas institutional Treasury holders and some domestic market participants as well. They needed to raise cash quickly at the onset of the pandemic. And there was a one-way flow of selling U.S. Treasury bonds that overwhelmed intermediation. And the Fed stepped in with, basically purchasing, essentially $1 trillion of treasuries in almost 5 weeks in order to restore that sort of normal market functioning. Now, the fact that during an economic crisis there was such selling of U.S. Treasury bonds is, in the first place, sort of an uncomfortable fact. But the Fed did at that time, they did demonstrate that they would do whatever it took to enforce smooth market functioning. And that in itself was an important signal. So when my co-author Robin and I, we're working on this chapter, we kept thinking, like, is this coordination? How coordinated is this? We're not arguing that the responses of each were closely coordinated, or the Fed action of buying treasuries in size of March 2020 was like with the direct intent of helping the other arm of policy. I mean, Chair Powell didn't sit in a smoke-filled room and say, aha, I'll do this, if you'll do that. It's just that, the pandemic begged for a policy response. Monetary policy was not well suited to provide. Lowering interest rates was not going to backfill lost income, the lost revenue of households and businesses. And the Fed, it can't provide the types of response that fiscal policy is better suited to provide. And on the other hand, the U.S. Treasury Department needed to issue substantial sums and do so without risking disorder, without risking a harmful backup in interest rates that could have been disorderly or slowed the recovery. So in totality, looking back, when we recap events and consider who bought and sold Treasury debt during the episode, we argue that the fiscal response was facilitated in important ways by the action of the Fed, keeping yields low, removing an enormous sum of treasuries from private sector balance sheets, all when that sort of debt issuance by the U.S. Treasury was important. And we also note that it's probably not coincidence that in the last 2 major fiscal expansions of the country, World War II and the pandemic, in both, the Federal Reserve played an important role in keeping yields low throughout the maturity spectrum of federal debt at a time when the nation needed to finance a big crisis response.
So is that kind of the 21st century version of monetizing the debt, or is that just a semantic thing that we're talking about?
Yeah, I mean, we had a fair amount of back and forth on that issue. I mean, for the most part, we don't think about it as sort of monetizing debt, right? I mean, it's not like we turned, long dated government bonds that, the government pays interest on and turned them into dollar bills. I mean, they were, it's a little bit complicated, but the Fed issued reserves, a cash-like equivalent in the domestic banking system as credits, to the accounts of those who sold the bonds to the Federal Reserve. And those reserves are an instant obligation of the Fed, which is an arm of the federal government. So you've essentially swapped, one obligation that you're paying interest on, a U.S. Treasury bond, to another obligation, reserves, and the Fed pays interest on reserves. So essentially, you're exchanging sort of one government instrument for another, both of which you pay interest on. It's just that the bonds have longer duration. Reserves are an overnight obligation, so you're going to put a lot of downward pressure on longer term interest rates by doing that. Now, the one caveat to that is currency in circulation did rise pretty rapidly with the expansion of reserve balances and the asset purchases. And, that does drain reserves, and the federal government pays no interest on currency, obviously. So there's a small element of this that, was probably good for, the fiscal outlook. I mean, it wasn't the intent, but it's more a byproduct of. But really, the first order effect is that, you've really just swapped one government obligation with another. And now the Fed's in the process of starting to sort of undo this operation by allowing some of the maturity, some of the securities on their balance sheet to mature, and those will have to be reissued to the private sector by the Treasury Department, kind of undoing some of this stuff. So it's not really monetization in the way, sort of the common charge is leveled.
Well, let's think a little bit about lessons for the future. You said that one of your two lessons was the U.S. could do this again if it had to. I mean, 20% of GDP sounds like a pretty big number. Are you confident that they could do that again, or what are the limits? I mean, we can't just do that over and over, can we?
Yeah, I mean, we're not really arguing that, we could do this in 2022 and then again in 2024 and then again in 2026. It's more an observation that if we look at bond markets, it does look like, the fiscal space appears relatively ample. I mean, market implied forward estimates of real neutral rates remain low. There seems to be ample general demand for U.S. government debt, even as the Fed has moved to start to shrink its balance sheet. And even as, yields have backed up here, they still are on a historical basis relatively low. But we do caution that, while we think we can run this experiment again, there are some important limits. The trajectory of U.S. federal debt, even before the pandemic, wasn't stable, right? I mean, the CBO and others estimate, ongoing increases in future years of debt to GDP. There is going to be some limit. So you don't want, one generation using the space up to solve its problems to prevent a future generation from being able to do the same. But, when we really think about what the limit of the Fed being able to facilitate this kind of debt issuance, the big limit in our mind really was inflation. It's really, very rapid increases in inflation, very, very elevated inflation that sort of undermines a central bank's power more generally. I mean, in the academic literature and in kind of practice. And it's also the case that, if inflation was too high headed into a crisis, as a practical matter, there are episodes in history, that might inhibit the Federal Reserve's response to a crisis and perhaps underwhelm. And if this episode does prove, too inflationary, that could have important signals for going forward that might limit the Fed's response. I mean, you could imagine that if this proves to be, just exceptionally inflationary, that every time the Fed expands its balance sheet, inflation expectations suddenly become unhinged, harmfully high, which then forces the central bank, as soon as it started to ease, to potentially turn around and have to tamp back down inflation expectations rather than provide an adequate amount of stimulus for the real economy. So when we think about what the limit is, the limit really is, I think, inflation, because at the end of this episode, and when we're done with everything, the Fed has to have retained or reestablished its inflation fighting credibility.
So are you kind of giving them on the blocking and tackling lesson a grade for the future lessons that at the midterm they got a good grade, but ultimately it's still too soon to tell? I mean, if the inflation continues, then would that change your view of what the lessons are for future crises?
Yeah, I think as we've sort of gone along in this writing this chapter, the view has changed to some extent, right? I mean, the elevated inflation, certainly, Wendy touched on this in her comments at the beginning of the conference. Does it look like it's too much? Well, perhaps it was. On the inflation and the Fed and its ability to, keep and maintain, those longer run inflation expectations that make it look like this will, end up being positive. I mean, we don't want to argue that we shouldn't have responded to the pandemic and we shouldn't have returned, real final demand to sort of pre-pandemic trends. But we don't know. I mean, we're still running this experiment. I mean, it could be the case that the Fed, gains credibility because they do successfully bring inflation back down. But at the same time, this inflation could persist, and maybe we do start to see those longer run inflation expectations really unhinge harmfully higher, and that then become a problem, hamstringing sort of future central banks. And we just don't know that yet. We can guess, but that's an experiment we're still running.
Okay, let's switch now to Gabe. So Gabe Chodorow-Reich is at Harvard. He came from Berkeley. He and I worked together during the last crisis at the Council of Economic Advisors. And he's got a outstanding paper, has been involved in doing the research, evaluating really let's call them the business interventions and rescues and those. And Gabe, why don't you take 5 minutes and tell us, I know you got 100 different programs that you had to think through, but why don't you give us an overview of the findings?
Yeah, thanks a lot, Austin, and to Wendy and Luis and David. Wendy also, we were on the Obama CEA with all together. But this is really a fantastic book, and I learned a lot from writing the chapter I'll describe in a moment, as well as from the other chapters. I really think it'll be a great resource for a bunch of people. The jumping off point of our chapter is a remarkable number and breadth of new programs to aid businesses. And many of these were designed and implemented within weeks of the pandemic starting. We count more than $600 billion of new business subsidies just in the first year of the pandemic recession. And of course, that unprecedented support for businesses went along with much less business distress than feared and an unprecedented and unexpectedly rapid recovery. That confluence makes it tempting to say that the central problem of depression prevention has at last been solved, which is a paraphrase of Austin's colleague, Bob Lucas. A theme of our chapter is to say maybe not so fast. There are other factors that have been discussed today, including the nature of the recession, the aid to households that help spur the recovery. And so we really need to think hard both about what policy should have done for businesses and what these programs did on a case-by-case basis. So we start the chapter by discussing a framework for what policy ought to do. And we focus on two efficiency reasons for business aid. The first is that credit markets don't function perfectly, and even long-term solvent firms might find themselves without the liquidity to survive. And that suggests a focus on a particular set of firms, those that have less access to credit markets, which you can think of as primarily being smaller firms in the economy. The second is spillovers or externalities. So for example, when workers who lose their job then buy less stuff, and that lowers total demand. So with that backdrop, I'll discuss just a few of the major programs that we review. The largest program in dollars, and also I think in public attention, was the Paycheck Protection Program, or PPP. This was a program that gave forgivable loans, so basically think of these as grants, to businesses of up to 500 employees, modulo a few exceptions, in an amount equal to 2.5 times their monthly payroll, up to $10 million in the first 2 rounds of PPP. In total, it accounts for more than $450 billion in grants to businesses during the first year of the COVID pandemic. The first observation in evaluating PPP is that a relatively small number of larger firms received a vastly disproportionate amount of the money. For example, the less than 2% of recipients that received grants above $1 million account for more than 1/3 of the total cost of the program. We discussed some evidence that most of the money to these firms did not actually ultimately finance payrolls, or put differently, that the cost per job saved at large firms was relatively high, and I'm happy to get into that later. There's some work that finds better effects on payroll for smaller firms, but most of these studies really focus on pretty short-run effects. So I think the overall grade to PPP is that it probably was not so crucial for the larger recipients, and it's more of an incomplete grade for the smaller firms. There were several less discussed SBA programs, such as the EIDL loans and advances, that were similar to PPP, but much more targeted to smaller firms, and therefore might be a better model going forward. There are some other programs that were large by historical standards, but have received much less attention from the scholarly community. For example, the CARES Act authorized $58 billion in grants to air carriers. Obviously, that was an industry that was hard hit during the shutdown. We need an air industry when things recovered. But of that 29 billion went out in the first year. 22 billion of that went to the 6 largest US airlines, which are all companies that broadly have access to public capital markets. Several have successfully undergone bankruptcy restructuring, albeit not all at once. So we think there's some skepticism to that program, but it's also a call to the academic community to focus a little bit more on some of these other programs. Finally, let me say a little bit about the Federal Reserve programs, specifically the corporate bond buying program and the Main Street lending program that allowed banks to offload 95% of a new business loan to the Fed. These were really unprecedented, both in creating channels for the Fed to directly supply credit to non-financial firms and in the required coordination with Treasury. The first notable aspect of both those programs is how low the actual outlays were relative to the authorization. For the bond buying, this seems to be a case where just the program announcement had important effects in calming the bond market. For the Main Street program, it's harder to argue that it had an important effect since it supported relatively few loans. But that in itself may be a sign of policy success because the program was really designed to kick in only when banks faced binding capital constraints. And as it happened during this recession, and this also reflects a lot of the household aid that was discussed earlier, banks were in pretty good shape through the recession. So just to summarize, in our analysis, there are programs such as PPP that have received a lot of attention. We think they could have been better targeted. Programs such as airline aid that seem harder to justify, and programs such as the Main Street Lending Facility of the Fed that played a pretty small role in this recession, maybe will be more important in the next one.
So if the PPP program, which was certainly got the most headlines and it's maybe received the most attention from the economists, if it wasn't that important for the large firms, and if we still don't know if it was that important for the small firm, how did people live? How did they survive without it? In a way, it's been surprising how few bankruptcies there were. There'd been a expansion of the new business formation. Was it the private financial markets stepped up and saved us, or what happened?
Bankruptcies actually went down in 2020 and 2021 relative to before the recession. And that's just extraordinary. Typically, bankruptcies are very highly correlated with the unemployment rate. And that just was not the case here. We did some analysis in the chapter looking at the firms where we can see their balance sheets and we can see how they're adjusted. So those are going to be primarily larger firms than even would have received PPP, but we think it's informative to understand what the business sector did. And so you see a couple of things. First, they cut expenses very quickly, and that's part of the unemployment rate going up. Now, of course, in many recessions, we would worry about that. A lot of that was cutting payroll at a time when unemployment insurance was made much more generous so that people could receive as much income while they were unemployed as they would have while they were being employed, and at a time where we were largely okay as a society with people staying home because we were trying to stop the spread of disease. That adjustment may have been perfectly efficient, and it allowed firms to cut expenses. The other thing that these businesses did was they raised capital. They did that partly by drawing on credit lines that were prearranged. That's something that would have been more available to larger businesses than the smaller businesses, which were less likely to have credit lines. And they did it by returning less money to shareholders. Not so much by cutting dividends, but really by cutting share repurchases. So these programs, similar to a dividend policy that allow firms to return money to shareholders, they sometimes receive a lot of criticism. Why are these firms giving back money? In this case, it allowed these firms a lot of flexibility to hoard earnings at a time when they really needed to do so. So that's part of the financial side of how they survived. I think the other main aspect is it was just a much shorter recession than was feared. And so the rapid recovery of demand, both because of the household aid, because of the nature of the lockdown, because of the speed with which vaccines became available. All of that meant that demand came back relatively quickly. And you can see that in the sales numbers for these firms, which rebounded relatively quickly. And so to the extent there really was a bridge that had to be laid, it was a shorter bridge than we might have thought it would have had to be in March of 2020.
So you kind of hinted at that in your opening statement, and there again, if this happened again 5 years from now, 10 years from now, what should we do different? How would you change the program to make it better or more effective?
Let me give you a couple of specific examples and ideas, and I'm going to do this, not to second guess policymakers in March 2020. I think they faced tremendous uncertainty. They designed new programs incredibly quickly, and I give a pretty high grade overall for what they did at that point. But of course, we know things now that we didn't know then. So one is the Paycheck Protection Program. I think this will be controversial. There are going to be a lot of people who really want something like it. I hope we can all agree that if it's something like that is done, it is done at a smaller scale and specifically a smaller cap on the total. So just to give you a number, if instead of a $10 million cap on payroll, that cap were $250,000, the total cost of the PPP would have been about half as much. And that would have changed the amount of money received by less than 8% of the borrowers. And that's exactly that 8% is the borrowers who the evidence we have suggests this was least effective. And the theory we have suggests they would have been the most likely to have alternative ways to survive. A second is the airline aid, which I spoke about a little bit already. I think there, even if we were to think we need support to large corporations, we ought to have mechanisms in place for the federal government and ultimately the taxpayer to benefit on the upside if the sectors recover. So things like warrants instead of outright grants. And that's, ironically, how some of the TARP, the 2008 aid was given. And of course, that received a whole lot of political blowback, but actually did have some mechanisms built into it that I think, for an airline industry would be good. And the third example, just to emphasize, not just trying to mirror the way that dollars went out in this recession, is the Main Street lending program. Really didn't do much because the banks were pretty healthy. I think that's the program that might have been very helpful in 2008 and 2009. Which was a recession where the banks really were balance sheet constrained. And in a future recession where that were to be the case, that sort of program might prove useful.
Okay, Chris, let's start on the third paper, and then when we're done, we come back onto some general questions. Chris is chief of the industrial output section at the Division of Research and Statistics at the Fed. He's, for the last 6 years, he's the perfect person to be talking about all the new data, private sector data, and alternative data that we use to understand this crisis. Partly because he's, for the last 6 years, been working on the expanded measurement agenda there at the Fed. So, Chris, this one's close to my heart. My own work on COVID used the phone mobility data. Tell us a little bit about what exists, what we learned, and what your paper shows.
Okay, thanks. Thanks for having me, and thanks for the introduction. And of course, this is a joint paper with Laura, Tomasz, and Stacy at the board, but this does not reflect any official opinion of the Federal Reserve Board. And I think just kind of starting from the top, this is kind of the perfect paper to wrap things up with, because the story of the pandemic recession is a story that we're telling through new data sources and understanding via new data sources, and it really is a story of data. And the perfect introduction to this is just hearing Mel and Anna and Laura and others talk about how not only did they kind of look at new data through the pandemic, but they still kind of want to lean on more data to better understand things. And this chapter was a great way of us to kind of put our thoughts down over what we've experienced and what we've been working with for the past several years, which really built on a lot of previous investment into new non-traditional data sources. So really, I think the overall takeaway point is non-traditional data, and this is what we mean by this would be kind of your idea of big data or non-standard data, naturally occurring data that's collected by mostly private organizations, things that aren't produced by your standard statistical agencies. It played an invaluable role during the pandemic recession and the subsequent recovery. And really, we try to provide a list of these sources within the paper. We probably are definitely not inclusive, but we try to hit on a lot of the different data sources. And like you just mentioned, I mean, there's the new location-based data. That's something that we've only been leveraging for a few years now. But at the same time, we point to things like rail car loadings, which was an important determinant of measuring economic activity back during the start of the Great Depression. So we try to provide a list of some of these sources in the paper and really kind of come to this idea that the benefits of non-traditional data really fall within three primary categories, and that would be timeliness, granularity, and crisis-specific data gathering. Timeliness is super important. We were able to see, and others were able to see, changes in economic activity weeks and months before the official statistics were released. And given the rapidity of the pandemic recession, it was absolutely important to have that kind of benefit of timeliness. Maybe one good example, and it's kind of cherry picking, would be just thinking about traditional data. The quarterly services data came out in August for the second quarter of 2020. So if we had to wait until August of 2020 to understand what happened in the service sector, for which we had flight information, restaurant reservations, movie ticket information to understand what's happening in those sectors, we would have been really behind in terms of trying to catch up to what's happening. Now, it's also important just to kind of, when we're talking about timeliness, make the point that the kind of March 2nd meetings, emergency rate cut, and March 3rd, a lot of that happened prior to the availability of any information that would be able to point to what was happening in the overall economy. And some of those decisions were based on what were happening overseas. There was some imprint on like daily sentiment numbers and travel numbers at that time. But really where non-traditional data started playing a role was about mid-March of 2020. So aside from timeliness, and this is something we've talked a lot about through this morning, has really been the idea of granularity. And so what do we mean by granularity? We mean frequency, we mean geography, we mean individual characteristics. And in many ways, the pandemic recession hit different subsectors of the economy more than others. And understanding that granularity has been important to either generating a policy response or at least understanding where we should think about these effects. Also, an important kind of benefit would be the crisis-specific data gathering. And that's something that really picked up, and we mentioned a little bit earlier when we think about things like the census pulse surveys, being able to answer really important questions at that time. And then kind of the last thing we focus on in the chapter is really the pitfalls. And there are pitfalls everywhere when we start talking about non-traditional data. And it's something that folks really need to take into account as they move forward and think about kind of like how you would learn lessons from this recession and apply it in the future.
So what are the pitfalls? I mean, it's on one hand, it seems like if we're going to have an explosion of all these new data, why not just take them at face value and use them? I mean, walk us through the downside.
So I would say that the three large pitfalls I'll just quickly try to hit on right now, and we kind of outline some more in detail in the chapter. The three primary pitfalls are really, primary pitfalls, and two of them are kind of related, are things that need to be taken into account when you think about data in general, but it's particularly important when you're thinking about non-standard data. Statistical agencies have hundreds of statisticians and economists and survey scientists putting in effort so that what we see that's in a release is valid, is time consistent, is a right sample, is giving you the information that they're promising. So I think the first, one of the most important things, the non-standard data that's been leveraged A lot of them don't have sufficient time series. A lot of them you started collecting at the time of the pandemic, and you didn't have enough history to kind of make decisions off those data. And an important thing of this is just seasonal adjustment. If you need 5-10 years of data to seasonally adjust, then a year of data is not going to give you the appropriate set of information to understand when that data series change, or understanding patterns, or understanding what kind of holidays are important for a specific data series. So that's a big pitfall. The second one, which is related to that, is just lack of history. You have to be skeptical of the data and aware of sort of things like sample attrition. These data, again, they're naturally occurring. They're collected by some organizations as a byproduct of another activity. And a good example here to point to, which was a really relevant and important piece of information data set that was used by many people to make decisions or determinations about the economy, would come from this company called Homebase. They do clock in, clock out type software. Again, timely, valuable, and this organization was really forthcoming in providing this information for individuals to use. We use some of that information to track business exits. And an important way to think about what the value of history is by, I think, February 2021, if you were looking at the Homebase data, you'd be able to say something like 33% of businesses had exited during the course of the pandemic. And you'd walk away looking at that statistic saying, wow, that's a huge amount of business exit. But you really need enough history to compare that to what happened, say, in previous years. And so having the 2019 data to compare that to would show you that the sample attrition in this data source was something like 30%. So if you're, or the sample attrition was basically, you'd point to, would be high enough that the excess exits were only like 3%. So walking away from some of these non-standard data sources with the idea that there's a large amount of exit and not understanding just the sample attrition in an organization that collects information or provides clock in and clock out software for free for organizations means you have a lot of turnover in that sample. And then I'd say the last kind of important pitfall to keep in mind is all of this data is not representative of the overall economy. And this goes back to my primary point about what statistical agencies do and the efforts they put into making a representative sample. So understanding the representativeness is going to be key, especially when you try to make determinations for the overall economy. And just to kind of return to the Homebase example, I think in September of 2020, there are a lot of forecasts for general employment that were negative coming out of some of these non-standard data sources. So I think with the Homebase data, people were saying that there'd be a negative 800,000 job loss in September 2020. And what really happened was something like positive 300,000. And that's a really different signal to take. And that's based on just putting too much weight on one non-standard data source.
Sounds like we might foresee, let's call it, recession-driven, crisis-driven data gathering in the future. But as you look at this one, are there any of those non-traditional data that you think would be more lasting, that we would keep, in your day job at the Fed, you would keep track of it, and 2, 3, 4 years down the road would still be useful and would kind of go into the canon of traditional data?
Absolutely. The pandemic, we really witnessed statistical agencies, government agencies, and private companies all kind of coming around the idea that providing information at the height of the pandemic and the economy was really valuable. And what they came up with, I think in some cases, is going to be enduring. But you're right, some of the information such as school shutdowns, office visits, healthcare related things are probably not going to be leveraged going forward. But I would say there's really 4 primary categories of information that will be leveraged going forward. And the first one you kind of touched on that you'd used in your own research is really the mobility and location measures. Like those speak to when you're thinking about visits to particular restaurants or visits to type of service activities or visits to just overall places that are being generated by the nature of holding a cell phone, then that's going to provide information going forward on economic activity, particularly when it's service specific. So the mobility and location measures became really valuable, and it was really great to see a lot of organizations just providing that information pro bono for either research or for policy analyses. A lot of the series that speak and we cite a few papers on this that speak towards business exit and entry. Individuals mentioned earlier, kind of the weekly business formation statistics were really valuable in the middle of 2020 to kind of say, we think that there might be a lot of entry going on now, which was kind of contrary to the idea that we'd see this mass exodus or this kind of this death of business dynamism. Some of the data series that speak towards business exit too are extremely valuable because the business employment dynamic statistics, I think for the fourth quarter of 2020 just came out today. So if we're really thinking about lagging information, then having an idea about what's happening with business dynamics is super valuable, particularly and timely. And being able to say something about what business exit was doing is really important at the time because we really cared about what's happening to businesses and that loss of, say, human and physical capital that would go along with shutdowns. Bottleneck information. I mean, this all started in March of 2020 with this idea that we'd see some supply chain constraints. And now we're right back in that situation. And I think for going forward, understanding more about shipping, individual ships at ports, container traffic, rail travel, that's going to be valuable. And that gives us an idea about economic activity. Again, this goes back to my point that, this is something we used to do back during the Great Depression. And this is something that Alan Greenspan really cared about. But understanding a little bit more about logistics and shipping is going to continue to be important. And then lastly, I think there has to be a really, large and resilient shout out given to census because the census pulse surveys that came up, that's going to continue. The value that was there that they could leverage in short time periods to answer like a specific crisis type questions was just super important.
Okay, well, you see, we've really spanned the map from monetary to fiscal to data. Let's loop back on some. Gabe, in some of your work, I was struck, and I was going to ask you at the tail end of your presentation. Does that imply that there were programs that the Fed announced and appeared to have a market impact? The municipal bond facility, only two, Illinois being one, but there were only two people who even took up the program. And yet it seemed to affect the spreads pretty significantly. Is that free? Can the government use its reputation, or is it the Fed's reputation? How did they do that? It seems like it was free money.
Yeah, it's really interesting. I'll talk about the corporate bond prying just because that's what was in our chapter. We didn't cover the municipal, but it's a similar analog. So what happened is the Fed announced they were going to buy corporate bonds. Initially, it was a relatively small amount. That the cap went up to $750 billion. And at the time they announced it, yields came down, and they came down especially on the bonds that they were eligible to purchase. Again, this is really unprecedented for the Fed to get involved with lending to the non-financial sector, to municipalities. And it's tempting to look at that and say, well, there were two equilibria. There was a sort of run equilibrium where yields were high and the market was not so functional. And then there was a good equilibria, and the Fed just moved us to the good equilibria. And so it was really costless. And that is consistent with the evidence. But there is another interpretation as well, which is that there was some concern that these firms were not going to pay back the corporate bonds. Somebody was going to bear that loss. And instead of the private sector, the Fed was saying, we will bear some of that loss. And moreover, not just on the stuff that they were announcing they were going to buy and they bought in March and April of 2020, but that they were going to sort of put a floor under things, and they were going to use all of that capacity to absorb losses in the corporate bond market. Now, in the event, as we've discussed, the economy recovered pretty rapidly, and so corporate bonds did not go into large-scale default, neither municipalities, and so the Fed got away with it. But there's an alternative reality where this had been a much more severe and long-lasting recession, where, in fact, the Fed was forced to put up the money and bear some losses. And this is just one of those things where, it would be nice to see that counterfactual. We can't really tease them apart. One piece of evidence coming from options markets is consistent with there being some risk that these things weren't going to pay off, and the Fed was actually putting some real money into it.
So Jonathan, then I'll throw one to you. It's kind of in that theme of you never know what would have happened. Everything we saw was contingent on this state of the world. Do you worry about, let's call it the reputation of the Fed or something? There were blurred some lines between fiscal policy and monetary policy, where the Congress says, we want to turn all this over to the Fed to run it. Let's say it had gone badly. Let's say the economy had not improved rapidly and we ended up losing tons of money on these programs. Do you worry that would have redounded on us, that the next time the Fed tries to coordinate with fiscal policy, people would say, the Fed, those jerks, they lost us to $2 trillion?
Yeah, I mean, the Fed losing money is kind of an interesting concept. Central bank accounting isn't like GAAP accounting, but yeah, I mean, their reputation matters a lot. And I think, it's important that, they didn't suffer severe losses. I mean, now that's another experiment that we're still running, right? And we have rising interest rate and the Fed owns lots of bonds. I mean, going back to the last crisis, there was plenty of work done by Monetary Affairs and elsewhere that, what happens if the losses put the Fed in a negative capital position, and there are ways out of it. I mean, you'll still have an operating Fed and that alone won't hamstring their ability to provide monetary policy. But I think to Gabriel's point, right? I mean, the politicization is a potential issue as well. I mean, when I looked at sort of my view of the corporate bond program, from the point of view of both having been at the Fed and a market participant, was when the Federal Reserve was created, the primary lending market was via the banks. The idea that now we have a substantial amount of non-bank lending that occurs in the private economy, it might be worth having a discussion about the extent to which the Federal Reserve's role is to backstop, some of those other sources of lending, like the investment grade bond market. But the way the post-Dodd-Frank use of the 13.3 authorities went, with the coordination with the Treasury is required. There was definitely Treasury coordination, but you could see when the facilities were being pulled back, by the administration, that there was a certain amount of tension between the two parties over whether or not those facilities should have been wound down at the start of 2021. And I think that is in an uncomfortable position for the Federal Reserve, where it wants to be, its independence is really crucial. And the extent to which it can be drawn into some of these programs and then some of them go bad, could just add to the politicization of the Fed. And I think that is kind of a dangerous worry. It's not necessarily, I think the Fed would have a problem with taking a loss. I mean, they certainly took risks after the financial crisis, but I think you walk forward the logic of some of this, and the politicization could be a problem when we really do need to protect its independence as an institution.
Well, I want to thank all three of the groups that wrote the papers. They're really outstanding. It feels like this book is going to be an excellent resource for us going forward. We're basically right on time, and I turn it over to our illustrious leader, Wendy, to take it from here.
Excellent. One of three, we're a triumvirate. So on behalf of me and David Wessel and Louise Shaner, thank you so much for joining us today. And again, I encourage you to join us tomorrow. We'll be at 1777 F Street Northwest from 9:30 to 12. And our keynote speaker will be Janet Yellen. So we hope to see you tomorrow. And if not, streaming online. Thanks very much.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.